Hi, welcome to Christensen Wealth Management. I'm Michael Christensen, and thank you for taking time out of your day to watch this weekly stock market commentary for the week ending Friday, January 18th, 2019. This video is being recorded on Wednesday night, the 16th. And before I jump into my comments, I'd like to begin with the quote of the week. This week's quote is by Napoleon Hill in his book, A Year of Growing Rich. Napoleon Hill once said, "Struggle is a clever device through which nature compels humanity to develop, expand, and progress. It is either an ordeal or a magnificent experience, depending on one's attitude toward it. Success is impossible, unthinkable even, without it." Those are some wise words from Napoleon Hill. Well, in this week's video, I want to tell you that I am thinking that as of today, that the Christmas, or I should say post-Christmas rally may be over. The stock market has slammed into much resistance, and I'll show you that on the charts, but we've got all kinds of resistance that lies above the stock market at this point. And I'd like to share with you a possible explanation for why the stock market has been rallying after Christmas, when so much of the economic news is negative. Doesn't make much sense that we would continue to have continuous bullishness with the Institute of Supply Management and Purchasers Managers Index and the Empire State Manufacturing Survey all coming in negative. It just doesn't make any sense that this would continue rising, and I have an explanation that may shed some light on what the market has been doing and why. And I'd also like to show you a chart regarding the October to January stock market move and how it matches up perfectly with the volume of trading. The sellers are in control of this stock market since October, and the sellers still remain in this stock market. There is very little buying going on in the market right now, and it's getting weaker by the day as the stock market goes higher. That is not a sign of bullishness. I will show you a chart that shows just that. Let's go ahead and jump into the charts that I was going to show you first regarding a possible explanation for this stock market rally, which is a possible intervention by the global central banks. Let's take a look at that chart. In this chart, courtesy of Zero Hedge, you can see the S&P 500 since about October 15th, and you can see that the U.S. macro surprise economic data and the Standard & Poor's forward earnings per share estimates. And so you can see that the blue line, which is the U.S. macro surprise data, was up here in the top left-hand corner as of October 15th. And the blue line keeps going down and down and down all the way from where it was up here at about 2,900, October 15th. It's now down here at 2,200. So the U.S. macro surprise data just shows that economic data releases are surprising to the downside, not positive surprises to the upside. So there's more and more negative economic data coming in, represented by this blue line, about every month, or I should say every several weeks. The other line, the red line, which was up here in the top left-hand corner as well, has been plunging relatively quickly since about December 10th or so. And that is the S&P earnings per share, which means that the Standard & Poor's 500 companies are revising their earnings downward rapidly. So as we're going into 2019, more and more companies are saying that their earnings are going to be falling as the year progresses, not growing earnings as the year progresses. However, strangely enough, you can see this lime green line and this fluorescent green line, but more the lime green line, which as of about December 21st took off to the upside, which represents the Standard & Poor's rally off of, I guess that would have been Christmas Eve, which the S&P bottomed out the day after Christmas and has been shooting upward ever since. So the S&P is rising rapidly and has gone up about 10% since Christmas. Meanwhile, the economic data is plunging, and the earnings estimates for Standard & Poor's 500 companies are plunging as well. So that is a very strange pattern, and the question is, which one is right? And the other question is, why is this possible scenario occurring? Well, let's take a look at this next chart, because I believe it may hold an answer to this puzzling question. Here is the other chart, courtesy of Zero Hedge, and you can see that the global stocks since February of 2018 are represented by the blue line, which were rising throughout May, June, July, August, and September. They peaked here at the end of September, and then global stocks fell rapidly into Christmas Eve, as represented by this dotted red line, just showing you the trajectory of that blue line. Now, the green line represents the global central bank balance sheet, which means if you take the central banks around the world, the Federal Reserve, the Bank of Japan, the Chinese Central Bank, the European Central Bank, and other major central banks, and you add them all up, what level or what quantity of assets have they purchased and hold on their balance sheet? When the line is falling, it means that central banks are liquidating their assets, meaning selling those assets, whether they're stocks or bonds, to the rest of the world. When the line is rising, it means central banks are buying. Well, you can see that throughout May, June, July, August, September, and October and early November, the green line was falling, representing that global central banks were liquidating assets from their balance sheets. And right about a month before the green line bottom, about a month before the global stocks hit their bottom on Christmas Eve, you can see the global central bank balance sheet starting to rise. And then as we got into the middle of December, the green line has begun to rise extremely fast, almost dollar for dollar with the global stock market valuation. So what this chart shows is one of the most likely causes for the rally in global stocks over the last 3 weeks or so is global central banks are intervening and adding assets to their balance sheet. So they could be buying bonds, but many central banks also buy stocks. And in this particular scenario, it looks to me like the global central banks are buying a tremendous amount of stocks and buying them on the open market and driving the prices of global stocks upward, boosting indexes like the Dow, S&P, and NASDAQ, as well as the European and Asian indexes as well. So we have a very strong correlation right here in the last 3 weeks between central banks buying assets and global stocks rising. That cannot be a coincidence. Now, before I go, I want to say that as of today, Wednesday, the 16th of January, the Dow Jones Industrial Average closed up about 141 points. It was up over 200 points for a while, and everybody was all excited. But the stock market gave back about 100 points into the close, closing up on the Dow 141. But everybody being excited is not quite what it should be, because only one company of the 30 Dow Jones Industrials was responsible for 100 points of that 141 points in the Dow's move today on the 16th. That is not a sign of extreme, widespread bullishness across the 30 Dow Jones Industrial stocks. So that's a pretty narrow participation when it comes to the Dow Jones Industrial Average. Short-term indicators right now are bullish from this 2.5 week explosion relief rally since Christmas Eve. But I would say that we're due to go back down and test those lower prices at least one more time. So keep your powder dry, keep an eye on your investments, stay vigilant, and remember, getting back to even is not an investment strategy. So let's see where this market goes over the remainder of January, and I'll see you again in about another 7 days. But before you go, please click subscribe on this YouTube channel and then click the little bell next to it so you'll be notified whenever additional videos are posted. And in the summary description of this YouTube video and in the top right hand corner of christensenwealth.com, you will find links to the social media pages on Facebook, LinkedIn, and Twitter for Christensen Wealth Management. Thanks, and have a great week. Bye-bye.